What is up, everybody? We are back with another episode of Bullish's Top Stocks to Watch for the week and why. This is episode 49. It's been 4 months since my last episode. Life happens, definitely trying to find a way to get these back in. I just started at the beginning of the year an MBA program, 4.0 GPA. Let's go. So it's about finding that time because I really enjoy doing these, but they do take a lot of time for me to kind of research, put things together, and then like record it and stuff. I love doing it. I met some great people, got some great ideas, some great insights, some great discussions. So I want to keep doing these. Is just finding that right cadence. I think it's going to be bi-weekly, which I think means every 2 weeks. So that's kind of how I'm going to try to do it going forward, maybe every 2 weeks. But okay, before we get into it, as always, hey, one, these are only my opinions. Do your own due diligence. This is equal parts entertainment, hopefully for you, education primarily for me, right? So I'm not a financial planner or advisor. This is what I'm watching, maybe playing for the next couple weeks. And hey, number two, if you like this episode, even if you don't, give us a like here and a sub on YouTube. Help me feel good about myself. Also, real_bullish, wherever you get your social media poison. I'm pretty active, relatively more active on Twitter, Instagram, stock twits. So real_bullish. I try to post some stuff, keep kind of like what I'm watching, things I see. I'm a repost king usually. But yeah, real_bullish, wherever you get your social media poison, like I said. Also, real_bullish.com. Go sign up for the newsletter. I think it was like every 20 subs I get, I throw some merch out there, like a random drawing. Nothing too crazy, but I have some shirts, don't have it on. But yeah, go subscribe. Appreciate you. Okay, let's jump into it. Watching a few for the next month probably. SPY, if you know me, I love ETFs, right? Just because they are, especially the Qs, the DIA and the SPY, just because that's the industry, that's the market, right? Specifically, I really like the SPY, even though it is down 60% from all-time highs that happened late 2021, early 2022, right? We're down 16% from those all-time highs that we had. Officially, a bear market is down 20% over that relative time period. We're not too far from there, right? We're about 4 percentage points away from that. That's going to be that 20% bear territory is about that 380 mark, right? But also, there's been a lot of pessimism. I'm not trying to time the market. I'm trying to invest into the future, right? I don't think it makes sense to time the market. Not going to happen, especially for me. Not that smart at all. But what I do love about the markets right now is there's a lot of pessimism, right? I posted some stuff on Twitter, so go check that out. But basically, when the market stops selling off, when everyone that wants to sell sells, right? It's as simple as that. Right now, there's just overwhelming pessimism, whereas the 2020, 2021 is overwhelming euphoria. So both are bad in their own rights, but now people are so bearish that it's almost bullish, right? In that sense, right? If that makes sense. But also with that sell-off, with that 60% decrease of SPY comes value, in my opinion. Not saying that things are done selling off. What I'm saying is that there's now value, whereas late last year and even in the year before, there was just you were overpaying so much for what you got, right? Let me get in perspective. The 10, 25, and 45-year average forward PE for the market is 16.9. Right now, the market is 16.8, right? So basically, we're at historical fair values if you're looking at it from the price to the forward price to earning ratio, right? So you're not overpaying. You're not getting the best of value for your buck, just yet, but you're not overpaying anymore, which is what I like, right? The market isn't kind of like oversaturated, overinflated in terms of the prices that you're paying at this point. This Jameson on the rocks, I'm telling you, is good. It's actually the second time I'm recording this, so I needed a little bit off the top because the first time I didn't like the audio quality, so I had to redo it, right? But anyways, like I said, those are what I'm looking at for the SPY. What I also like, so if you're looking at the SPY, I'm stepping back a little bit. Usually I do month, year, day, month, week, day, but I don't want to get into the days of this like as market is now. I want to get into the year, month, and then week and maybe some days. But when I look at the SPY, I wish I would have looked at the year sooner, specifically last year. If you hear my dog going off, I have some DoorDash coming. Pizza is on the way, so I apologize if my dogs are barking. As spoken with, what the fuck do you have in your mouth? I don't even know what's in his mouth right now. Can y'all tell what in that fool's mouth? Bro, is that my sock? It's my sock. Okay, it's nothing crazy. It's just my sock. He's like a sock monster apparently. No, I don't want it. Okay. Anyways, so like I was saying, you have a hammer here on the top. This is great at the bottom of the formations, not at the top, because what it signifies is like a lot of selling pressure and it can't break through. But what we do see, and it makes a lot of sense, is when we had that like heavy kind of euphoria coming in for 2020, right? You had that hammer on the top signifies, hey, there might be some correction coming, and then it leads into 2 years, basically 2021 and into 2022 of a double top pattern here, which makes a lot of sense, right? So you can kind of tell at the year level that some shit was about to happen, right? You see, like I said, relative strength indicator 30 and 70 are two areas of possible correction. 70 is too much euphoria, 30 is too much pessimism, generally speaking, right? These are generalities. But so we saw that RSI going too hot, it's coming down to correcting at the year level. MACD is still, and MAC moving average convergence divergence is still kind of steady at the year level, but I wouldn't expect that to hold on if the markets keep doing what they're doing. What I am seeing though at the month level, like year, month, day, is we do have almost like it's not a spinning top, but basically we have some indecision here as we're following this resistance, this support level lower, right? Basically starting from one, let's say this is 122. So the beginning of the year, you did have some lower lows coming in. And if you connect those lower lows that are coming in, you get almost a downward support level, right? So that support is leading us down, right? Also, that resistance at that same thing, you can at the top of them, that resistance is leading us lower, but it's holding at that downward support level here. So far, no volume over average, but it's going to happen. We're only halfway done with the month, and we're basically pretty close to volume over average, right? You have the RSI, like I said, going from that overbought still to the oversold, right? Once it crosses this line, we'll see moving average conversions divergence still bearish. So this, it's what it is right now at the month level. But interestingly, at the week level, and this is why I sparked my interest, is remember how we saw that hammer at the top of the formation, right? This is the hammer at the bottom of formation, which is bearish or bullish versus bearish, right? So when this is at the bottom, similar to the last time we saw this, which was the month of so basically 221, right, of this year, you saw that formation of the hammer, right? It's like a hammer at the bottom of the pattern, and you did see a relative short like kind of pop there to the upside. We might be able to see this now while we have this hammer at support level at the bottom of this channel again, but it's still leading us lower. The volume over average, over the past 2 weeks or past 3 or 4 weeks, actually, past month have been there over average. So still a lot of selling pressure. Like I said, I'm not saying that we're at the bottom, but I'm saying that we are not as overvalued as we were, definitely at the beginning of the year, right? We're getting to normal prices where prices probably should be, right? Maybe a little bit lower, but also RSI is still going down. But like I said, 30 and 72 areas of possible correction. Right now, we're at that 30 level. So, that pessimism is almost getting overwhelming. That's almost good, right? Because people that need to sell, and then the buyers hopefully can step in, or at least people can stop selling as much. Hopefully, volume over average returns if it's still selling side, a little bit lower, right? MACD moving average convergence divergence doesn't show any sign of slowing down there. We did have at the day level, I know I said I was going to look at days, but we did have a gap up that was pretty cool there, almost like a little gap up here, trying to reclaim that area of support at the 405. But hey, smart people are saying 380. That's the area that it wants to get to, right? But also, the way I think about it, when you're looking at the SPYs, you're looking at the indicators, you're really trying to invest for the future, right? And barring a recession, and let's say we do have a recession or some economic downturn, there's this good book that was referenced to me. I only have the cover right now because the book's in my car, or my backpack in my car. But basically, a very smart and very beautiful person, said, "Hey, read this book, The Changing World Order: Why Nations Succeed and Fail." I'm not pulling this out of my ass. Basically, in there, it's saying, recessions, economic downturns generally last 2 to 3 years. I'm just quoting it from here, right? But you can probably Google it yourself. So, like when you think about, at least when I think about, these ETFs, especially ones that shadow the market, I'm not trying to like downfish and find the bottom. I'm trying to find that value and make sure my money's growing in the next 3, 4, 5 years, right? Even with a recession coming in, that's going to last 2 to 3 years. As long as you don't need that money in that time frame, which this money you shouldn't be using. For me, it does. It's not things I need tomorrow or the next day. It's things I'm happy investing for the long term. Speaking of some long term investments, as we looked at the SPY, which is heavily weighted in tech and healthcare, right? Those are like probably the two biggest ones. The SPYD is an interesting alternative to that, but also, so SPYD is basically the SPY, but the 80 highest yielding dividend companies in SPY, right? So this is kind of the opposite in terms of their allocation for their holding percentages, where I said tech and healthcare were for the SPY, the big ones. For the SPYD, the top three industries, here they are in order: utilities, energy, financial, right? Basically the opposite of SPY holdings. And like I said, this is only the 80 highest yielding dividend companies in the SPY, right? They have a quarterly ex dividend actually the second week of June. So basically we're at 515 today. This time next week, next month is going to be the ex dividend date. And how the ex dividend dates work is you have to be in that ETF at that date for you to get the dividends when they pay out, probably in the next few weeks after that, right? So that's coming up here in the next month or so, right? So this is, like I said, a dividend. It's a quarterly dividend, a 3.6% yield for your money you put in. Top three industries, like I said: utilities, energy, financial. The top three holdings of those are one Valero, two Marathon, three Chevron. And that's pretty interesting because that's giving you some good energy, some good oil and gas. Also, on the top 10 holdings is Exxon. So if you think of the super major oil and gas industry, oil and gas companies, right? The four biggest, publicly traded companies that you can trade in the United States stock market, right? Two of the four are in the top 10 holdings for this SPYD, right? And the great thing about that too is if you're betting that all of this, people are going to be traveling more. The war in Ukraine is still popping off, so gas and energy prices are going to be higher in the near term future. That just bodes well for SPYD, right? Also, a lot of these energy and oil and gas companies cut their dividend when the pandemic hit because they didn't know what was going to happen, right? So now they're slowly increasing that dividend payment. So not only what I see as catalyst as the prices for these underlying holding companies, gas and energy, getting more expensive, the dividends, in my opinion, are going to keep increasing to that pre-pandemic level, especially if it's oil and gas energy companies. So you got two kind of catalyst tailwinds there, because as these companies start paying more dividends, it's going to look more attractive to those SPYD investors that are looking for those dividend payments, right? And like I said, quarterly dividend payments are going to come out there. And as we looked at for the SPY, that's down 60% from basically year to date, right? Looking from January, year to date means this year so far. So you're looking from January to this month. Ooh, DoorDash on the way. Let's go. This is up 2% basically year to date. So not bad considering where the market is in general, down 60%. Also, what I really like about the SPYD, Seeking Alpha. So I subscribe to two things. I subscribe basically to Seeking Alpha and I subscribe to Barron's, right? Because I just find value in what they send me. It's $30 a month, but I just love it. It's fun for me to read. Seeking Alpha has a strong buy rating over the past month. This is into strong buy territory. That's basically the highest rating that they can give, and the ratings are just getting stronger. So over the past, they're about a 4.89, and that only goes to 5 in terms of their strong buy rating, right? So I really like their strong buy rating. It's been really good. You got to take it with a grain of salt, but when that's just their recommendation based on all these quantitative, not qualitative, but quantitative, like bells and whistles and shit, but also you have to do your own due diligence. I'm going to get over the next month, I'm going to look more deeper into the SPYD to look at the individual holdings. That's how I do ETFs, right? But so far it looks really good, especially with that ex-dividend date coming up this time next month. But also when you look at the SPYD at the year level, right? Nothing too crazy here, right? It's, you're moving average conversions, divergence is going up the right way you want to see it. It's over this channel, which I really like, this 39, basically it's called a $40 area. It's an area of significance that we're looking at here, right? And if you get a little bit closer, you can kind of see it better here. But at the month level, you do have a lot of volume over average coming in at the month level. Basically, this month, we're only halfway through. 88 million shares have traded in this ETF, and regular volume is usually about 24 million. So we're busting that up. But like I said, 70 and 30 are two areas of possible correction. So at the month level, we are getting closer to that overwhelmingly optimistic area. So you have to watch out for that. Moving average convergence divergence at the month level looks like it's basically been bullish for a while, basically since 121. So the past year and a half, let's say, it is looking like it wants to pinch at the month level. So we might see some sell off here that retest this 40 level, which I love because the more you can buy at a lower level, the better your dividend yield is going to be. And the more you can buy basically. So at the month level, it does look like it wants to cool off, but it doesn't look bad at all, especially with that volume over average coming in. At the week level, you do see kind of something similar. So the week level, what I like, it looks bad, but it actually looks good to me at the same time. So at the week level, you have about 59, let's say 60 million shares traded of this ETF, where volume is basically at what, 10, let's say 11, 10 basically million. So we're trading so much volume. It is bearish to the downside, but what's interesting is that you have an area of significance here. Like, it's been respecting this area of 42.58, but also all of that volume over average trading had got you an indecision candle, right? So look, what I mean by that is the wick is basically long as shit. The candle body is small compared to this side. So it's an inside candle to this previous bullish one here. So that is a lot of indecision, even though, so sellers came in, they tried to break this down low. Buyers came in and raised it basically to the top of that candle level, which I love. You do see RSI going down. It was kind of stabilizing here, let's say at this 54, 55 level. It is going to try to break down under that. MACD is still kind of flat too. So at the week level, it's not looking bad. It looks worse than it actually is, in my opinion. I like it, especially with the ex-dividend date coming, especially if it does hold this 54 area. And I have alerts here. Hey, if it breaks over this, let me know. If it breaks under this, let me know. It is making kind of like lower lows almost, but it's really fighting. There's a lot of support and resistance also at this 42, 52 area. I like it, especially with dividends coming down the way. All right. Looking at the next one, speaking of being, so these are all super defensive plays, right? I'm not trying to get cute with it. I'm not trying to like make money tomorrow, the next hour, the next week. I'm looking for a long-term defensive time horizon where I can put my money and feel good about it, even when I'm down, which I am fucking down in Google, but I feel good about it, baby. The next one I want to go into is SHY. And basically, this is an ETF that gives investors or people exposure to short-term treasury yields. They're bonds, basically. You're buying into the bond market, specifically treasury bonds. The great thing about treasury bonds is there's no risk of default. You're not buying bonds of a company, you're buying treasury bonds, right? So backed by the government, basically, right? So, and these are short term. This is a 2 year. Basically, if you look at this ETF, the average, I think, timeline for this one is 2 years to expiration for these. But also what you get with that. So basically bonds, stocks and bonds, right? And this is one of the class I took. I love it. If you need a book on basically investing, almost value investing, financial accounting, 6th edition, Michael Halen. This was a book from my class. I actually rented it, but just kept it because I highlighted so much and it's so much good information in here. It will give you a good explanation of bonds versus stocks. But basically, there's a difference, and I won't get into like in it, but I won't get too deep into it. Look it up. It's interesting how it works. But basically, bonds are similar. It's an investment for you, but the way the company that you're giving your money to sees it, you're no longer just an investor. You're a creditor. What that means is that you have priority if a company were to go, if this was a company it was to go bankrupt, since you're a creditor, you have higher priority to get that money back from you than you if you're an investor, right? If you have common shares, if you have preferred shares, you're above them as a creditor. You are lending these people money. Also, the great thing about having bond exposure is that you get interest payments. Think of it as a dividend. And whereas we saw with the SPYD, it was a quarterly dividend, you get monthly dividends or interest payments with SHY, right? Or SHY. I'm looking at SPY, but it's SHY. You get monthly interest or dividend if you can think about payments, right? And this is different because of the rising interest. Why this is interesting to me now is because we know that the interest rate is going to keep rising. The Fed's Jay Powell's going to come out and he's going to keep pushing the interest rates up for the foreseeable future. Definitely to the end of the year, we know it's going to be about 3 or 4% that he's going to raise it to. Since it started and we know it's going to happen, you don't look for this one at the interest payment. You have to look at the 30-day SEC yield, and that is actually 2.09 versus the reported dividend or interest payments of like, I don't know, like 0.23 or something. So because interest rates are rising, but we know what they're going to be, since the Fed is raising the interest rates, but we know what it's going to be, it makes this one a lot more interesting to go into because it's not a question mark anymore. We know it's going to happen. We know about how much, and I think that's why you're seeing some of the rebounding in this price, right? I will say though that for this one, what I'm looking at is right exactly now. 82.85 is an area of significance for me for this one. And at the weekly, it's not looking too bad. So if we step out of it, and I can show you kind of how I do it, right? So we have this double top here. That's easy at the week level. Boom, draw a support line here. Boom, there's an interest here. Right here, drawing some levels because just connecting the bottom with the top, right? It's easy to look at it at the year level, right? It looks interesting. A lot of downside pressure here, but that's because bonds basically were we didn't know what was going to happen for the past basically since the pandemic. Now we kind of know interest rates we're at zero to we're going down to zero. That's out of the question now. We know that the Fed's going to raise interest rates, and that's why I think we're catching a bid here, specifically at this level of 82.53 or sorry, 82.85. I think I want to say, yeah, 82.85. Because this has been an area of significance before, right? Connecting these lines, looking at this as being resistance, then it was support. Now we're here again for support. And we have kind of an interesting double bottom at the month level. And as you can see, RSI is picking up to be, like I said, 30 and 70 are two areas of possible correction. Now we're correcting to the upside at the month level. Hopefully MACD can kind of catch that bid soon. I like to think of RSI and MACD as one moving faster and slower. RSI is kind of that faster moving vehicle, and MACD takes a little bit longer, but it's more indicative of the kind of sustained momentum that's going to happen for it. So even with the month level, month is a longer time horizon. RSI is catching, which looks really good, specifically at this area of significance. And couple that with kind of like, yeah, I pick my nose. Couple that with the monthly interest payments you get for the money you invest. That's not too bad. So it has a lot of things working for it, right? At the week level, like I said, this is why I really liked it when I looked into it, is because you are seeing a lot of support where you want to see support, right? And it tested this bottom of this area, 82, 85, let's say, and now it can catch back up, right? But more importantly, at the week level, as we saw MACD was picking up at the month level, at the week level, it's still doing that, right? It makes sense. It's doing it at the day, week, month level, right? It's just one is faster than the other, right? So RSI is catching up at the week level to get back to regular territory over the oversold area. But more importantly, you have MACD. DoorDash is approaching. Yo, man, those odds gonna go wild. You have MACD coming up as well, right? Pinching to want to be bullish as well. And hopefully that will progress to the day level as well. But I really like the support at this level here. At the week level, same thing. You see RSI has been picking up for a while. MACD is going the way you want it to go. It's finding support where it wanted to find support there. So I really like this, especially if you want to get into bonds. What I love about this one is that like you don't need a special like bond market tool or you can get this on Robinhood because it is an ETF, a pretty popular one. You can trade this on Robinhood SHY, which I think I'm gonna do. Ooh, that fool's gonna get mad about that. I get it. Food's here. The other one I'm gonna go to is Twitter because it is an arbitrage. Sorry about that. It is an arbitrage play. Basically, if you don't know what arbitrage is, hey, chill. If you don't know what arbitrage is, it's the practice of taking advantage of a difference in price in two or more markets, right? That's what arbitrage is, an inefficiency in the market. And what I like about this, I think about it as an Elon buyout arbitrage play. There's an inefficiency in the market, and we're trying to take advantage of it. So over, I think it was 5:13, so 2 days ago. So I think it was on Friday or Thursday. Elon mentioned Twitter. He tweeted, "Twitter deal temporarily on hold, pending details supporting calculation that spam fake accounts do indeed represent less than 5% of users." That was Elon, and I think that's an interesting play because he's saying that, hey, I'm pausing on this. I'm not out. I'm still interested in buying Twitter. I think that so the original price is about $54, right? That's a 33% difference from where we are now. If you look at Twitter trading at 40.72, right? Elon's not going to pay a 33% premium when he can say, "Hold on, I have concerns," and get it at a lower price. What I'm seeing chatter about is $44 area. This is straight from Barron's. Like I said, this was something I pulled from Barron's magazine. They actually talked about it for the past 2 weeks. I've been looking at it. I sent it to people. They didn't kind of respond about it. But basically, Barron's is quoting that $44 area. That's about an 8% difference from where we are now. If you're looking at the SPY is down 16% year to date, making an 8% difference is not bad. No, that's predicated on Elon buying Twitter. So worst case, to me, in my mind, how I'm looking at it, a bad case scenario is you're getting 8% from where it is now. Best case scenario, you're getting 50, you're getting a 33% increase from where it is now. But let's also say Elon doesn't buy Twitter, right? What are you doing, right? You can do a couple things. You can sell it because you're an arbitrage player. You can hold it. I would think the stock is going to crash if Elon gets out of it. I think that I'm an Elon fanboy. You know me. I like Elon. I like what he does. He's CEO of 4 different companies, basically, and still he shows no sign of slowing down. What Elon wants, in my opinion, Elon gets. And if he wants Twitter, and it seems like he does want Twitter, he's going to get it. He's just finding the best price to get it at, right? But let's say he doesn't get it at the $54. Maybe he doesn't get it at the $44. Maybe he doesn't get it at all. He doesn't want it. I still like the company, but it's expensive. And what I mean by that, if you look at the forward price to earning ratio, it's sitting at 36. As we said with the SPY, the average at fair market, it's at fair market basically. You're not overpaying too much, relatively speaking, for the SPY, right? At 16.8. This is at 39, right? So you're sitting basically at 40. Or sorry, this is at 36, right? Price to earning ratio, basically 40, let's say. So it's expensive. You're not getting a lot of value there, but what you are getting is 229 million daily active users. That's a lot of fucking users. So they're growing. They have people that are daily users, 229 million of them. And you, over the past 5 years, if you look at their earnings, they actually have, so if you look at their financial statements, their revenue and gross profit have gone up over the past 5 years. So even though it's expensive, there's a reason for it to be expensive, in my opinion, because you're getting a lot of users and you're getting revenue growth and you're getting gross profit growth, right? Also, what I just read and what I did on Twitter, basically Elon said, I just saw this tweet today when I was looking this up, to fix your Twitter feed because algos are running it. Basically, he said, very important to fix your Twitter feed. Tap the home button, tap the stars in the upper right corner of the screen, and select latest tweets. It changes the whole Twitter experience. It is instead of the algos running your Twitter, it's actually just like, a timeline based on when the last tweet was. I don't know if I like it better. Maybe I like the algos running my Twitter better, but also it's not too bad. But so that's my play for arbitrage Elon, right? Let's call it. The last one I'm going to, and I'm gonna eat this pizza, and then I'm gonna go buy new plants because I have a plant I'm on the hunt for. I got into plants recently, but yeah, so I got a plant that I'm looking for. I saw it at a coffee shop and I was like, I want that motherfucker. PANW, Palo Alto Networks, they have our earnings on 5/19. That's Thursday. While I like Palo Alto Networks, even though they are expensive, it is expensive for a reason, because it's cybersecurity and also defense, right? Wars aren't just fought with bullets and rockets and drones. Bullets are fought with computers, fucking nerds sitting there fucking computering and matrixing and shit. And you have to counteract that with companies like Palo Alto Networks, like CrowdStrike, like Okta. All of them are expensive for a reason. But I will say that inflation and higher interest rate is making your time value of money more immediate and less in the future. Meaning you're paying right now, because of the environment of inflation and the interest rates going up, your money makes more sense now versus the money you're going to make in the future, right? So a lot of these multiple high earning or high growth companies are getting knocked, specifically Palo Alto Networks. So as we saw, the SPY is 16, let's say 17 for price to earning ratio. And that's normal. That's saying you're not overpaying, you're not underpaying. Twitter's at fucking 36 or whatever. And Palo Alto Networks is actually at 67. But that sector is hot and it's growing. But if you're looking at it from specifically like an earnings play, let me just give you these numbers. Over the last 20 earnings, they have beat earnings per share 100% of the time. They have beat revenue 95% of the time, right? So you can bet that they're going to beat earnings. They're going to beat EPS. They're going to beat revenue. The question mark for me is going to be guidance. Are they going to give guidance? Because you really need all three. And even when you have all three in this environment that we're in now with the SPY down 6%, you might not catch a bid and get up. So I'm looking at this for a post-earnings play with good numbers, right? They are expensive, but cybersecurity, defense, it's there. It's not going to slow down. We're getting more connected. We're going to have more protection. Palo Alto Networks is one of the leaders, right? Also, if you look at the same quarter year after year. So if you look at this time last year, their EPS growth, so their earnings per share growth, is expected to be 31% estimated over what it was this time last year, right? So that's pretty impressive too. It's expected to grow, and if you look at their past earnings, they beat EPS and they beat revenue. So in my opinion, I don't have to worry about that. I don't. But also, they only have a 63% probability to go up after earnings, right? So there's that caveat. That's why I'm saying maybe I want to wait a little bit because this market isn't the market that's going to give you a lot of pop. You could always catch the same thing you can always catch something you want at a price that it's been at before, right? You know what I'm saying? Like you pop and they sell off, you pop and you sell off. So it might be worth watching that pop, catching it as long as they have good numbers, which I'm thinking that they're going to do. But anyways, I'm going to wrap this up and get this pizza. You got the SPY because hey, I'm betting that I'm betting on the long term economic viability of the American market, the American economy. To me, I can't go wrong with that one. SPYD, I'm really looking at that one because of that dividend payments. Like I said, the 80 highest yielding companies are in there. SHY, getting that bonds, monthly interest payments you can get at a really interesting price point right now. Twitter for that Elon arbitrage, PANW for those earnings. I hope everybody has a good week, 2 weeks. Appreciate you joining me again. See you again.